Hey, what's up, my friend? So in today's training, you will discover the price action strategy that I have been using for the last 7 years. And once you master it, you'll be able to spot trading opportunities like this, all right? So the best part is this, right? This trading strategy that you're about to learn can be applied to the stock markets, the forex market, or even the cryptocurrency markets. All right, so here's a breakdown of what you'll learn today. Number one, I'll walk you through the basics of this trading strategy, right? What are the things to look for, the market conditions, the entry, the exits, the stops, target, etc. Once you understand that, we can move on to the advanced stuff, right? Because here's the thing, right? When you look at the chart, there are so many support resistance areas to trade off. How do you know which are the higher probability ones that you want to focus on so you have low risk and high reward trading opportunities? And once you understand that, we'll then move on to the final section and share the secret, right, to capturing explosive moves in the market before it all happens. Okay, so all this and more in today's training. Sounds good? Then let's get to it. Okay, now let's get started with the basics of this price action strategy, and then later on we move on to the advanced stuff, right, on how to identify high probability reversals, capturing explosive moves before it occurs and stuff like that. So for this basic price action strategy, we are looking for a few things. Number one, we are making sure that the market is in an uptrend. Okay, so you can see over here the price making a series of higher lows, higher lows, higher lows, higher highs, higher highs, higher highs, and pretty much this trend is towards the upside. Number two, we want to make sure that the price comes towards an area of value. So what is an area of value? So area of value can be things like support and resistance, area where buying pressure could step in to push the price higher, or areas where selling pressure could come in to push the price lower. So since this is an uptrend, we want to look for area of value like support. So now question is, how do you find support in this uptrend? So to identify support, right, I have a full-fledged training somewhere on my YouTube channel. You can search on it if you want to learn more, but the brief overview over here is you want to look for points, swing points on the chart, right, where the buyers have stepped in to push the price higher. So some swing points that I can see over here is this. Price came down, then push up higher. This is another one. Price came down lower, push up higher, then made a pullback, and then push up higher. So these are all the key swing points that most price action traders would pay attention to. So these are potential area of support on the chart. And I'm going to highlight this particular area out, this one here. Okay. So why is this significant? Okay, so first, look at this. Price made up a move up higher, made a pullback, and then break out. So this over here is previous resistance. Price then came back and test previous resistance, which could become support. So this is a very common phenomenon where price breaks above resistance, and it could come back and retest as support. Likewise, if the price were to break below support, okay, break below support, it could come back and become resistance. So over here, it became a support, and then it bounce up higher once again. So this over here is a potential area of support. So now that we have identified our area of support, area of value, the next question is, when exactly do we enter the trade? There are professional price action traders who just have limit orders. They blindly just enter from the area of value. But for me personally, I prefer to wait for an entry trigger, a confirmation that tells me that, hey, the buyers are stepping in to push the price higher. And to look for entry trigger, there are two very common candlestick patterns that you can pay attention to. Number one is what we call the hammer. That looks something like this. The second one is what we call a bullish engulfing pattern. So the price, let's say, comes down lower, then there's a red candle over here. Then what happens is that for the bullish engulfing pattern, the next candle is a green candle that engulfs or cover the body of the previous candle over here. So this is what we call a bullish engulfing pattern, and this is a hammer. So these are usually the two most common bullish reversal candlestick patterns that you will likely encounter. So let's see what happens. So in this case, the market came towards this area of support. So now this is where we're getting primed, getting ready. Hopefully your alerts have trigger you and let you know, hey Rayner, the price is at support, pay attention. Yeah, that's what you want. Okay, and let's see what happens next. Boom, we have a hammer candlestick pattern. So what's the story behind here? So the story is pretty simple. Market is an uptrend. The price then made a pullback towards this area of value, this area of support. So on this day, the sellers, or rather the market opened at this price point, and the sellers took control and pushed the price lower near this lows over here. At this point, right, many traders will think, man, Rayner, this market is bearish, support is broken, short, sell, okay? And what happens next is that the buyers then stepped in and pushed the price up higher, closing near the highs of the days. So in this case, right, would you want to be a seller or a buyer? So if you think about this, right, there are a number of factors in your favor. Number one, uptrend. Number 2, at an area of support where, you know, buying pressure could step in. And number 3, you have a hammer candlestick pattern telling you that, hey, there are buyers stepping in at this point in time. So at this point, I hope you are looking for a buying opportunity. Okay, so for me personally, I would prefer to be long at this point in time. So what you can do is go long on the next candle open. So let's say the next candle, the market opened here. Let's say entry, we put it in green to signal our entry point. Okay, I'm just change this to green. Okay, now what about our stop loss? Where should we set our stop loss? Okay, so let me just remove this box over here to declutter things. So when it comes to stop loss, there are many ways to do it. There are traders who like to set it just below the lows because they think that, hey, if the price reaches this lows, the trade is invalidated, I want to get out of the trade. But for me personally, I have seen many times, right, where the market reaches these lows over here, and then it reverses and goes up higher back in my favor. At that point in time, I want to smash my head against the wall. Aha! So I don't want that to happen to me. So to minimize that occurrence, what I usually like to do is to set my stop loss a distance away from support, a distance away from the lows. So usually somewhere about here, right? You know, so again, if you don't want to aga, you don't want to, you know, have this subjective element of, you know, where to set your stop loss, you can use a tool like the average true range indicator to help you with it. So this is the average true range indicator at the bottom. In case you're wondering, man, Rayner, where do I find this? So let me just walk you through. Okay, so I'm just going to remove this. Go to indicators, search for ATR, click on this. Ta-da, it's out. For my settings, I go with usually the SMA 20 period because there's 20 trading days in a month. And right now the value is about, you can see over here, 1.221. Okay. So now how do we interpret this value? Very simple. What this means is that over the last 20 trading days, this currency pair, Swiss franc against the Japanese yen, moves an average about $1.20 per day. Okay. So using this number in mind, right, we can actually find out what is the low of these candles, of this swing low over here, and then minus 1 ATR. So let's say, looking at this over here, this swing low, it's about 137.15. So I'm going to take 137.15, and minus 1 ATR. And you know the ATR value is 1.22. I mean, I can be a bit more precise and put 1.221, but I'll just make my life easier. Yeah. So I'll take my trusty calculator. 137.15 minus 1.22, and that gives me 135.93. Okay, so with this value in mind, that is where my stop loss is going to be. Okay, so let me just walk you through 135.93. So I'm going to set this over here. I'll change this to red, and I think I'll just change this to 135.93, and that will be my stop loss. So in essence, right, what the stop loss means is that from this swing low to this red line over here is a distance of 1 ATR. So that is basically the volatility of this market that we are taking into account, so that we don't get stopped up by the, you know, sudden spikes down or spikes up in case if you are short. So moving on, where do we set our target? Where do we take profit? So when it comes to taking profits, there are many school of thought. There are many ways to do things. You can, you know, have a trailing stop loss to ride massive trends, or you can look to, you know, just capture that one swing, one move in the market. So in this case, let's say we go with swing trading to capture that one swing. So usually for the swing trading rule, we usually want to set our target before opposing pressure steps in. So where is opposing pressure? Where could opposing pressure step in? So if you look at this chart over here is where I would say opposing pressure could possibly come in because it's an area of resistance. Yeah. So this is where, again, an area where you want to set your target. So in this case, let's say we set our target before this area of resistance. Okay, let's change it to blue as our target. Yep, so there you have it, right? Our entry, stops, and target. And if you want to take things a step further, you want to find out, hey, Rayner, what's the risk to reward on this trade? Well, we can actually use a tool like this, this one here, right? Oh, sorry, this one here. Click long position, right? Then you click on this green line that I've drawn earlier. Just adjust this stop loss one to this red line, the top one to this blue line. And then we'll see what number does it give you. A risk to reward of about 1 to 1.15. So you're risking $1 to make potentially $1.15. And if you think about this, you're trading in the direction of the trend, your winning rate usually should be better than 50%. So you can see that in the long run, this strategy, right, should give you a positive expected value, positive expectancy. And do you want to see what happens to this particular outcome of this trade? Let's find out. Okay, so yep, clearly pretty much reach your target relatively shortly because it's a cherry pick example, right? Because this is basically to help you understand the concepts that I'm teaching. So the examples in this training video, they're all cherry picked again because it helps you to understand easier. But in the real world of trading, you will have winners and you will have, guess what? losers, right? So don't be surprised, right, when you encounter losers along the way. Okay, so you have understand, right, the basic strategy. Okay, if you don't, I'm just going to do a super quick recap just for you, right? So identifying markets which are in an uptrend, okay, coming back towards an area of value like support, looking for a bullish reversal candlestick pattern, go long on the next candle open, or you can use a limit order, stops the distance below the lows, target just before the recent swing high. Pretty straightforward stuff. And if the market is in a downtrend like what you're seeing right now, it's just the inverse. So now the next question is that, man, Rayner, when the market is in an uptrend, there are so many areas of support. Which are the ones should I pay attention to? Great question. Okay, so one way to go about it is to utilize this concept of what I call, some traders call it confluence. I call it a stacked area of value, where multiple area of value comes together that makes it even more powerful. So there are other ways to define your area of value. You can be using moving average, trend line, etc. But today I want to share with you another concept that you are probably not familiar with, and it's using the open, the quarterly open, right? This is a tool, a technique that I learned from Trader SZ. So what exactly is a quarterly open? So let me explain. So quarterly open, right? Basically in a year, you have 4 quarters: January, April, July, and October. So the first trading day of each month, the opening price of the first trading day, that price point is the quarterly open. Okay, so let's say, for example, January 2nd, for example. Okay, January 2nd, right? The market opens, the first trading day of January opens at, let's say, $100. Okay, so the $100 is the quarterly open for that quarter. So the $100, right, is the quarterly open for the quarter of January. So you can actually project the $100 all the way, right, to the end of March, right, and that is the quarterly open. And to make your life easier, there are indicators to help you with it. There's this one over here which I use. Just going to show you where to find it. If you go to settings, so you can see this one is called DWMQY. OPP. Okay, I'm just going to remove it so you know where to find it. Just go to, again, indicators, search for quarter open, and it's by this guy called Copacelli. All right, Copacelli. All right, click on this. Oops, click wrong thing. Click on this over here, yep, and that indicator will be shown on the chart. Right, where is it? Did I not click it? Let's try again. Quarter open. Come on, Copacelli. There we have it. All right, there we have it. Yep, there it is. So go to settings. You typically just want to show the quarterly open. You can show all the other opens, right? But not for now. And then for the style, I think just leave the quarterly open one. There we have it. Okay, so I'm just going to show you on the chart how it looks like. There we have it, the quarterly open. So in case you want to see the settings, again, I just set the quarterly open, click OK. And what you're seeing over here is a series of dotted lines, and those are pretty much the quarterly open. So if you look at, let's say, this one over here, this is the start of July, the first trading day of July. You can see that the dotted line on this day's opening price, it projects all the way, right, to where we are right now. Same for this one over here, on the first trading day of April, the opening price, project all the way, to where it is right now. Notice how straight my line is. Not bad, huh? Maybe I can, be an artist, right, part-time. So anyway, you can see over here, the quarterly open, these are prices that you know ahead of time. And these are potential areas of support and resistance on the chart. So I'm just going to zoom out a little bit and see how this market respects the quarterly open. So look at this over here, quarterly open, price breaks above it before it came back down lower and about to retest it once again. Here, not bad, right? This quarterly open, price came into it, had a bounce, break below the quarterly open and retest previous support, which could become resistance. In this case, there's no test over here, but if you treat it as a zone, right, you can, say, hey, not too bad as well. In this case, quarterly open here, price is consolidating below the quarterly open before it hits down lower. This one, quarterly open here, right, price breaks through it and then face some resistance, right, at this quarterly open before it breaks out higher and retest it once again. Same for this is a quarterly open, price retest it, slight bounce, retest, bounce up higher, came back down lower, head up higher before it breaks below the quarterly open once again. So you can see that all in all, right, this market, right, the dollar against the Mexican peso, right, it does, respect the quarterly open. So that's one potential area of value that we can look at. We want to see whether it's respecting previously. If it does, great. Next thing, if you look at this currency pair, notice over here, it tends to retest previous support, which could become resistance. So if you draw here, right, this is previous support, projected out, right, became previous support, became resistance. How about here? Previous support, right, become resistance. How about here? Previous support becomes resistance. What about here? Previous support, which could become resistance. Okay, so let's see, right, what happens next. So now the price, we have two potential area of value to trade from. Okay, from this smaller one over here, and then this area of resistance right over here. So let's see what happens. So in this case, the market head up higher into this area of resistance, and then boom, right? We have a bearish reversal candlestick pattern. I think this is what they call a dark cloud cover. Yeah, so at this point, again, you have multiple factors going in your favor. Number one, price is in a downtrend. Number two, it got rejected off this quarterly open, as well as this area of resistance. So you can, let's put it QO plus resistance. Okay. So can you see how this stack area of value is coming together? And number three, you have this bearish reversal candlestick pattern. Yeah, so this to me is again, right, multiple factors coming together, right, to help me trigger, right, this trading setup. So, of course, if you want to enter the trade, you can just simply go short on next candle open. Or if you want to be a cheapskate, I'm usually a cheapskate. I like to place a sell limit order just to get in at a better price. Right? So if I see the market closes here, sometimes I might just place a sell limit order a few pips higher. Let's say over here, okay, somewhere here, just to see if I can get filled at a better price. So let's say green again is our entry. All right, let's see if we get filled. In this case, boom, right, we pretty much did on next candle, we got filled. Again, right, stops and targets, right, I'm not going to go into too much details, but stops is usually a distance above the high, somewhere about here. I'll just put this to red, so this is my stop loss. And target, usually I set it before this recent swing low, if you want to capture that swing, so somewhere about here. Okay, so I'm just going to change this to blue. Okay, so in this case, right, let's see what happens next. So again, this is a cherry pick chart. You can see that the market consolidated a while before reaching our target, right, and in this case, it then continued to rally up higher. So you can see that the concept of swing trading that I'm trying to share over here, why I don't like to set my target at the extreme end of the lows, because support and resistance, it's an area on the chart. It may not get to the lows of this support before it rallied up higher. So if your target is usually a bit too far, right, beyond support and resistance area, let's say somewhere about here or here or here, you may not get filled, and then you'll see how the price will then reverse against you and then hit your stop loss. So that's the reason why usually when I set targets, it's usually a bit more conservative, right? It's before support and resistance, right, on my charts. Now, besides the quarterly open, you can also use other type of opening prices, right, to define your area of value. So this is going to be fun, right? Pay attention. And by the way, if you're enjoying this training so far, smash the thumbs up button. If not, hit subscribe. So as I was saying, right, the quarterly open is one way to define your area of value, but it's not the only way, right? You can use, so some other open that I find useful are, let me just list up over here for you. Number one, we talk about the quarterly open, right? That is useful. Okay. Number two, the yearly open is useful as well. YO, yearly open. And number three, the previous year's high or the previous year's low is useful as well. Okay. So where do you get all these indicators? All free on TradingView. Let me just show you. So the yearly open, right? You can just go to here. I just show you the settings. Just look for yearly open levels, right? Just go to indicator. You search for yearly open, right? Something is going to pop out, right? And you know, just go ahead. I believe this is the one I'm using, yearly open levels by Joachim Hillam. I believe so, right? So you can see yearly open levels. The other one would be the previous year high or the yearly high, low, yearly. So you can go to indicators, search for high, low, yearly. I believe this is the one I'm using. It's this one over here by Repo32. Okay, so this is the one. So again, I have all these indicators up already. So I'm just need to release them, right, on the charts as and when as I need to. So again, right, nothing has changed. The price action strategy is still the same. Number one, we're looking for a market or a stock in an uptrend. So this stock is pretty much in an uptrend. Okay, so as you can see, right, in an uptrend, you have multiple area of value to trade from. This one here, this one here, this one here, this one here. Rayner, which one should I choose? I can't decide. You know, like choosing girlfriend, right? Just pick the one that, make you the happiest. No, not that, right? So anyway, this example, again, using the concepts which I've shared with you, we are looking for stack area of value. So this is where we can, bring in the yearly open, the quarterly open, and see, where it lines up. So let's bring out the yearly open. Boom. Hey, not bad, right? This area of support coincides with the yearly open. Wow, interesting. Now, what about the quarterly open? Let's find out. Boom. Wow. The quarterly open is also near the yearly open, and this is an area of support that you can see on the chart. Let's see. What about the previous year's high and low? How about that? Let's pull it up. Boom. Wow, this red line, right? So what is this red line? Let me just explain. So this red dotted line pretty much represents the previous year's high. So you can see that right now is 2023. The high of 2022 is demarcated by this level over here. And the lows of 2022 is demarcated by this low over here. So that explains why this blue line over here is the previous year low, and this red line is the previous year's high. So what's important now is to pay attention. This area is what I call a sweet stack area of value. You have multiple levels coming together: the quarterly open, the yearly open, the previous year high, and an area of support. When you see such trading opportunity, please tell me, right? Sometimes I might even miss these opportunities out. So if you see it, please tell me, drop me an email, let me know, Rayner, this has multiple stack area of value, pay attention. Thank you, I would appreciate that. Right? So this, again, right, is an area of value worth paying attention to. So what do you do next? Again, look for a valid entry trigger to go long. Could be a hammer candlestick pattern, a bullish engulfing pattern, a false break setup, etc. So in this case, let's see. Market head towards this area of value. Boom, right? Starts to bounce up higher, but still not a valid entry trigger. Boom, heading up higher. At this point, again, some traders might FOMO, have the fear of missing out. They chase. Again, I don't chase. The price either comes to my area to trade off, or I skip the trade altogether. In this case, price then came back down, forming something like a hammer candlestick pattern, but closing near the lows of the day. And then boom, the next candle, we have this green candle showing signs of reversal. So at this point, okay, this tells us that, hey, the buyers, or rather the sellers tried to break below the lows of this price point, but failed. Notice how the price came down lower, taking out the lows of support, but couldn't, as the buyers then step in and close near the highs of the days. So to be honest, I find that buying near these highs, right, it's a bit too much for me. I prefer to get in at a slightly better price. So what I'll do is I'll usually have a buy limit order to see if I get filled or not. If I get filled, great. If I don't get filled, never mind, I'll move on to the next trade. So let's say I place a buy limit order somewhere here. Let's change this to green. Okay. Then let's say my stop loss is, again, as you know by now, it's usually 1 ATR below the swing low. Let's say somewhere about here. I'll just change this to red as my stop loss. Okay. And let me just remove all the opening prices so it doesn't clutter the chart. Okay, and you can see much better now. Okay, so my entry will be somewhere about here, stop loss somewhere about here. I'm not giving precise levels because, again, you know how to do using the ATR method I shared with you earlier. So let's say the next candle open. Oh, you can see clearly I would have gotten filled, right, as the market actually did open at a lower price. Or rather, not open at a lower price, but rather it opened here and traded near the lows of this for this day. But since my buy limit order is here, I would have gotten filled anyway. Now, what about target? So earlier you learned how to capture a swing, and now I want to talk about how you can actually ride massive trends in the market. So if you just zoom out, you can see this stock is pretty much in a nice uptrend. And capturing a swing, it's not wrong. It's a perfectly legitimate way to, trade the markets. But there are some traders who think, man, Rayner, I want to ride massive trends, bigger the better. Big is good, yeah? So how can I do that? Many ways you can do it. You can use, indicators, market structure, etc. So one simple technique to share with you right now is you can use a tool like a moving average. So I'm going to pull out the simple moving average indicator, demarcated by this blue line. Okay, so this is the 100-day moving average. Click OK. And so what this means, right, is that you can actually continue holding your position as long as the price is above this blue line over here. And till the price closes below this moving average, this 100-day moving average, then you exit the trade, right? So that's one way you can go about trailing your stop loss. So in this case, all right, as I've mentioned, right, it's all cherry pick chart. So over here, you would have continue holding this trade as the price didn't close below this blue line. So continue holding until it closes below it, which is somewhere about now. Still not yet. There we have it. On this candle, it closes below the moving average. This is where you exit the trade, thereby giving you the opportunity to ride trends at the market. Of course, when it comes to trend following, bear in mind that your winning rate is usually below 50% because you are giving your trade quite a bit of breathing room to breathe, right? So this is why the longer term trends that you capture, your winning rate naturally will go down. So don't get shocked and realize, hey man, Rayner, why is my winning rate only 40%? Well, that's because when you are right, your winners are a lot bigger than your losers. Yeah. Alrighty, so we've covered quite a bit so far in this training. So earlier you've just learned how to identify high probability reversal areas in your chart. Now we're going to talk about how you can actually get into trades right before the boom, right, the big moves occur. So to do that, right, I need to explain to you a concept about volatility. So volatility in the market is very interesting. It's not static, right? Volatility in the market has a cycle, right? It moves from a period of high volatility, right, where the market, is so crazy every day, and then it gets quiet, for weeks or even months, and then boom, right, volatility explodes up higher once again. So to illustrate on the chart, it looks something like this, right? Market expands out higher, then volatility gets quiet, starts to tighten up, and then breaks out either higher or lower. Okay, then it goes quiet again, and then maybe possibly break out higher this time around. So you can see that the market, right, the volatility moves in cycle. So clearly, right, when you want to get into trades before the explosive moves occur, you want to do it in a low volatility market environment. And how do you spot such low volatility environment? So pay attention to the chart, right? You typically want to look for tight consolidation on the chart. So in this case, I have one over here. Notice the volatility of this market, right? The price isn't really going anywhere. It's just kind of like chopping up and down within this very tight, narrow range. So this is where you want to do business, because this is where trading opportunities lie. And this is, by the way, it's a daily time frame. And it's very hard to time your entry on the daily time frame when the consolidation is so tight. So this is where you need to kind of like level up a little bit and use multiple time frames. So if you usually spot a tight consolidation on the daily time frame, you can go down to the 4-hour time frame to look for trading opportunities. So let's say we go down to the 4-hour time frame, it looks something like this. Now, at this point, right, does this look familiar? Well, it should be, right? Because this pretty much is the same concept or same strategy that you have learned earlier. We are looking for price to retest this area of support to look for potential buying opportunity. And the trend is, again, as you can see, towards the upside. But before we talk about the entry trigger and stuff like that, I go back to the daily time frame. The area of value, right, on the daily time frame, as you can see, is this one over here. Previous resistance, breaks out, become support. So this is a key level, just using basic technical analysis. But as you've learned by now, right, you can use other tools, right, to define your stack area of value. In this case, you can use your, your yearly open, quarterly open, and see if this is significant. In this case, I believe the previous year low is this blue line over here. So this is significant, right? This coincides with the previous year low. And notice how significant it is as the price came into it, rejected, hit down lower, rejected again, hit down lower, rejected again, hit down lower. This is actually the same area of resistance that became support, which I shared with you earlier. But imagine this previous year low is already decided on this first trading day of, in this case, I can't remember what year this is, 2023. First trading day of 2022. In this case, this example is on the first trading day of 2022. Look at this blue dot over here. Okay. All right, the first trading day of 2022, you already know that this is the previous year low. And you can project it way ahead of time. This is not a lagging indicator. This is like a future projection, right? All the way ahead of time. So again, this is a useful tool. And this is a previous year's low, right, that we have on the chart. So what about our quarterly open? Let's find out. Look at this. The market, or rather the quarterly open, is also at this area of value. You have multiple factors coming in. What about a yearly open? Let's just pull it out and see. In this case, the yearly open is, I should set this to 2022. Okay, let's see where's the yearly open. Okay, not quite. The yearly open is over here. And notice how the yearly open is also acting as an area of resistance. Tested once, twice, 3 times. Is this magic or what? You decide. Okay, so anyway, the concepts and strategies that I'm teaching you is meant for you to go and research and develop it and make it your own, right? So don't take what I said, right, with, like the holy grail. Oh, Rayner, I trust what Rayner says. Don't trust what I say. Never trust anything. Always verify everything. Okay. So anyway, since the yearly open is not too relevant, right, let's remove it. Okay. So now we know that this is a stacked area of value, and that's not all, right? We also have a consolidation that's forming over here. And as you know, the market moves from a period of low volatility to high volatility. So now it's a low volatility environment, and we want to look to do business at this area of support. But as you know, right, on the daily time frame, it can be difficult to time your entry at this area of value. So what we can do is go down to a lower time frame to time our entry. Okay, so let me just remove those levels to declutter the chart. Okay, so going down to the 4-hour time frame, what are we looking for? Again, we are looking for the stuff that you've seen repeatedly over and over again. So we're looking pretty much for a bullish reversal candlestick pattern, right, to take out this area of support, to take out these lows, and then close up higher. So if, let's say, I were to identify this area of support, be somewhere about here, right, waiting for the price to come into this area, take out the lows, and then close back above it. Let's see what happens next. So in this case, the market then come towards our area of support over here. This is where, again, right, your watch list, your signal should alert you. Hey, Rayner, pay attention. Okay, so now we have a slight bounce over here. Boom, right? There's another. Now we have this bullish reversal candle. This is what we call a bullish engulfing pattern, as this candle has engulfed the body of the previous candle. So at this point, you can look to go long on the next candle open. So I'll go a bit faster. You're already familiar. Let's just change this to green. Okay. And let's say our stop loss again is a distance below this low, say somewhere about here. Okay. Change this to red. Okay. Now, I want to talk a little bit about targets. Right. As you know, this is a market which is in a low volatility environment, and you don't want to just capture that one swing, because what if the market explodes up higher in your favor, and then you just capture that 1R, that 50 pips, and that's it, and the market continues to move on, like maybe say 300 pips, right? So you're leaving a lot on the table. At the same time, right, what if the market moves in your favor and then reverse and then hits your stop loss, right? So you see your open profits turn to losses, right? Also not a good feeling. So what can you do about it? So this is where we can go with a hybrid approach. We look to capture a swing and ride a trend at the same time. So let's say for example, we buy one standard lot of Euro Aussie, right? We can take 0.5 lots, take profit 0.5 lots just before this recent swing high. So let's say I just change this to blue. Okay, I just change this to blue. Okay, let's say if the market gets to this blue level, we exit half our position. So in this case, the market did eventually, reach this blue level. We exit half of our position. So half our position, we have book profits and it's in the money, it's in the bank, right? So we have another half of a position remaining. So the other half of the position, right, nothing changed. The stop loss is still at this level, because this is where our trade will get invalidated. And it's either it hits our stop loss or it gives us a chance, right, to ride this new uptrend. So let's see what happens. So in this case, the market then can see chop up and down, breaks out higher, right, into this area of resistance, which is the yearly open, as you've seen earlier as well. Then it came back down lower, right, to our entry point. Okay, so you can imagine how difficult psychologically this can be when the market moves in your favor, go against you, moves in your favor. So when you take a portion of your position out in profits, psychologically it's going to be much easier to handle. Then you can see rally up once again, right, messing with your mind. And now breaking out of resistance. Will this time finally break out? Let's find out. Right, it comes back down under resistance again. Collapse back now, heading back towards the mid of the range. And then finally, we have this breakout over here, right? So I'm not going to, walk you through the different trailing stop loss mechanism that you can use. You can use moving average. You can use market structure. Maybe market structure is something that you're not familiar, just to explain. So as you know, right, an uptrend consists of series of higher highs and higher lows, like this. Okay. So what you can do is that whenever the price breaks out higher, in this case it breaks out higher, you can reference this previous swing low to set your stop loss. So until the price breaks and close below this lows, right, like this, right, breaks and close below it, then you exit the trade. If not, you can continue holding the position and to ride the trend up higher. So I think this example very clearly illustrates that trading can be simple, but it's not easy, because psychologically, as the market moves in your favor, moves against you, moves in your favor, moves against you, it will wreck your mind. It will make you take decisions, right, that is not part of your plan, right? So this is why it's very important to have a ready-made trading plan ahead of time, right? You know where exactly to enter, you know where exactly to exit, because at this point you can know that this red line is your exit. You will not exit the trade till this red level, this stop loss is hit, right? So until then, you just continue holding that position, right? Either you hit your stop loss or a new trend is born and you get to ride the trend. Does it make sense? Now, at this point in time, you might be thinking, but Rayner, all this cherry pick charts, all hindsight trading, blah, blah, blah. I get it, right? So right now, I'm going to share with you a live potential trading setup, right? It has not happened yet, but I'm going to share with you my thought process, right? How I'm looking to trade this market based on the strategies and the tools and techniques I've just shared with you. Sounds good, right? So I could be right, I could be wrong, but hey, it doesn't matter. The thought process, right? The way I'm going to engage this market, this is what matters, right? Because when you do this repeatedly over time, the next 100, 500, 1,000 trades, that's how you get your positive expectancy from the markets. So again, let's have a look. This is dollar against the Indian rupee. I've reset the chart. You can see I zoom out, right? What is this market condition doing? You can see that this market is pretty much in an uptrend. Great. Next, what I'm seeing over here is a volatility contraction. So a few things first. I noticed that recently we have this area of resistance. Price made a series of higher lows, higher lows, higher lows, and then it broke out of resistance. Then it retests back this previous resistance, which could become support, and right now it's kind of like consolidating. So when I pay attention to this consolidation, it forms a build up, right, or a tight consolidation, which we talked about earlier. So this means, right, that I could actually possibly get an entry, right, somewhere in this tight consolidation on the lower time frame. So now the next thing I also want to find out is there a stack area of value? Is there any other confluence factor like the yearly open, etc.? So let's see, I pull out the yearly open. Pretty nice, right? You can see that this market, the yearly open was drawn way ahead of time at the start of 2023, all the way project all the way to the end of 2023. Right, price tested once, twice, 3 times, 4 times, pretty much the resistance that I drawn out earlier. Okay, so hey, if the price can come back towards this yearly open, this is a potentially a stack area of value that I might want to trade off. So let's see. So going down to the lower time frame, like the 4-hour time frame, now I have a few area of value. There's an area of value I want to pay attention to. This one here. Okay. So I have an area of support on the 4-hour time frame that coincides with the 2023 yearly open. So how am I looking to trade this? So if the market can come down towards this area of value and give me something like, let's say, a hammer candlestick pattern, or maybe like this, even a bullish reversal candlestick pattern, that's a sign, right? That's a signal that, hey, I want to go long. I can go long on next candle open, stops a distance below the lows. And what about target? So target, I'm going to go with a hybrid approach because I know that this could possibly lead to the resumption of this uptrend, and I want to ride this uptrend up higher. But at the same time, I know the market could possibly go up, come down, go up, come down, go up, come down, whipsaw up and down, and mess with my trading psychology. So as much as possible, I want to exit half my position right before opposing pressure steps in. And where might opposing pressure step in? This over here is an area of resistance. Okay, so if the price goes up higher, just before this area of resistance, I want to take half my position off the table. So this way, psychologically, it's easier on me. And then I have the remaining half. I can, ride the trend, right? Or ride the position, right? If the trend resumes itself. So this is my game plan, right? To trade a dollar against the Indian rupee. And hopefully, right, through this tutorial, which I've shared with you earlier, you understand how this price action strategy, right, will allow you to profit in bull and bear markets, whether you're trading stocks, currency, crypto, etc. Now, I know I've covered a lot in this trading, so let's do a quick recap, right, to what you've just learned. Number one, we talk about the basic price action strategy, which looks something like this. Wait for a market to be trending, in this case an uptrend, let it come back towards an area of value like support, and look for a bullish entry trigger like a hammer, a bullish engulfing pattern, right, to get long. You can enter the next candle open or using a buy limit order, stops a distance below the lows, and if you want to capture a swing, target is usually before the recent swing high or before resistance. And of course, if you want to ride massive trends, you can use a trailing stop loss. Then the second part, we talk about the stack area of value using things like the quarterly open, the yearly open, the previous year highs or the previous year lows, right, to identify a stack area of value to help you filter out which are the higher probability areas that you want to trade off. And finally, we talk about the capturing of explosive moves, right? So if you spot a tight consolidation on the daily time frame, you can go down to a lower time frame like the 4-hour time frame, and again look for that same basic price action strategy that you've just learned earlier to get an entry, and hopefully allows you to capture the breakout or the explosive moves, right, when it happens. Now, if you have enjoyed this price action trading so far, then you will love, right, this book called Price Action Trading Secrets. Right? It's a full 142 page, right, full color trading book, right, where we dive into price action trading strategies and techniques to profit in bull and bear markets. We talk about candlestick patterns, we talk about market structure, we talk about support resistance, how to know when it's going to break or when the price is likely to reverse from it. We talk about breakout strategies and much, much more, right? So go and grab a copy, right? I'll put the link below this video, right? We ship to almost anywhere in the world. And here's the thing, right? I want you to be absolutely satisfied, right, with this book. So here's what I'm going to do, right? When you receive your copy of Price Action Trading Secrets, right, you have a full 60 days to read it. And after you read it, you find that, man, Rayner, this is not for me. I didn't get the value that I was expecting. Guess what? Just drop us an email and we'll happily refund you in full. Plus, you can still keep the copy of the book. Sounds good, right? Then I'll put the link once again below this video. Click on it, grab a copy, and I will talk to you soon.